Okay, I'm going to do something a little bit different in this video. I'm frequently asked to do the better series of indicators work on Forex markets, and I've recently kind of changed my tune on this. Historically, I've been a bit of a zealot, a purist in terms of just trading the E-mini, but I'm going to show you what my current thinking is in terms of the Forex markets. First of all, just to need to recap very quickly on the better series of indicators. There's the better sine wave, which is based on price alone. Then we've got better momentum, which is based on the volume traded at the bid and the ask, and then better pro-am, which is based on the average trade size. Now, the beauty of these three indicators is they're non-correlated. They're each looking at a very fundamentally different piece of data, and so you get maximum amount of information with the minimum number of indicators. And traditionally what I've said about Forex is, well, because we don't have volume data, we can't tell the average trade size, we can't tell the volume traded at the bid and the ask, that you should avoid the Forex markets. At the very best you can do is kind of use tick count as a proxy for volume. However, I'm starting to rethink that, and the reason for that is the advent of the growth in the Forex futures markets that's happening on the CME, and I'll show you shortly just some kind of volume trends that are happening there, and they're starting to become more representative of the cash Forex markets. Most of the Forex market trading that goes on around the world is the interbanks Forex market. There's no central exchange, there's no clearing house, and as a result there's no kind of volume disseminated to traders. However, there are futures contracts for the Forex markets, and they're traded particularly on the CME, and they're starting to become larger and a bigger part of that market, and I believe they're starting to become more kind of representative, and you can use it to trade using the better series of indicators. The other problem that I've had with Forex kind of historically is that you've got too many decisions. With E-mini trading, you've got one market to look at. All of the equity markets are tightly correlated, whether you're looking at the Dow, the S&P, the Nasdaq, the Russell, and so on. And then even across different markets. So if you're looking at the DAX, if you're looking at the SPY in Australia, whatever it might be, all of those equity markets tend to move kind of quite closely aligned. And so with Forex, because you've got a dozen different pairs out there, you've got far too many decisions to make. And again, I'm starting to rethink this. Just like the equities markets being highly correlated, a lot of the Forex markets are highly correlated, and they kind of break down into two different camps. The first one is kind of the risk or the growth currencies, which are things like the euro, the Aussie dollar, the Canadian dollar, Brazilian real. They kind of represent markets where people go to get high growth, to find kind of risk plays, and to take more risk in their trading, versus the kind of the flight to safety currencies, or the currencies that are being used to fund carry trades. And the largest one of those is the yen, because of the low interest rates in Japan. Then recently we've had the US dollar again because of the low kind of wholesale funding rates. What that means is you should be kind of not trading currencies within a particular grouping, so not the euro versus the Aussie, or the Aussie versus Canadian dollar, because they'll be very kind of tightly aligned. You should be trading across those two kind of categories. So you should be trading the US dollar versus the euro, or Canadian dollar versus the euro, or the Aussie dollar versus the yen. And the largest Forex market out there is the euro versus the US dollar, and that represents almost about 60% of the total kind of Forex market. And so if you wanted to trade Forex, why not stick with something that represents a huge part of the market, and you don't have to worry about the other kind of smaller parts of the market. The other choice is to go for something which has very large ranges because of the nature of the two different markets. And a good example there is the Aussie versus the yen. The Aussie is a very high growth currency, so when people are looking for exposure to growth, they'll go to the Aussie, and then they'll fund that in yen, so you'll get a very large differential in movements between the yen and the Aussie compared to something more like the euro or the USD. The moves aren't as great as in the Aussie and the yen. But the total size of the Aussie yen market is smaller, so the euro USD is kind of a good compromise. And I'm starting to think that if you were just to trade one Forex market, you kind of stick with the euro USD, and that would be the equivalent of, say, trading the E-mini as representative of all the equity markets kind of around the world. And then the last kind of criticisms that traditionally I've had is that it's a 24-hour market, the Forex market, and you have to be on your toes in order to catch moves in the right time zones. And there are pros and cons of that. One of the pros is that you can actually choose a currency pair that actually works for your particular time zone. So if you're not in the US kind of time zones where you'd be trading, the natural trade would be something like the US dollar versus the euro. If you're in, for example, the Asian time zone, the Aussie versus the yen is an extremely good kind of currency to trade in that particular time zone. So I'm starting to change my tune in terms of trading Forex. I still, my preferred market is always going to be the E-mini, no question there. But when I'm asked the question now these days, do the better series of indicators work on the Forex markets? I'm beginning to say yes, because you can use the Forex futures contracts, which has volume data, and then you can trade one Euro USD or two kind of Forex pairs and get rid of this kind of too many decisions type problem. Just as an example, I'm going to show you how big the futures market is versus the cash market. So, and these numbers are a little bit difficult to get behind because we don't have absolutes here, but as an example, in the cash market, so this is the interbank Forex market, there's roughly 4 trillion US dollars traded a day in that total market around the world. And then if you think that there's about 21 trading days a month, roughly 60% of that market is euro versus USD. That gives you a figure of about $50 trillion traded per month in the euro USD contract. And then if you compare that with the futures market there, we know the average kind of volume traded at the moment is about 6 million contracts a month. Each of those contracts is trading a notional value of 125,000 euros, and then just using a rate of $1.35 USD to the euro. That gives you about 1 trillion per month of the euro versus the USD. So you can see that the futures market is still extremely small. It only represents about 2% of the cash market. However, I'm going to show you some charts on TradeStation just to show how even though it's a much smaller market, you can still take trades using the better series of indicators and using the volume data that comes out of the CME futures contract. So I'll just show you those shortly. Okay, so now I'm going to show you some TradeStation charts for these CME futures Forex contracts. And the first one I'm going to show you is the EC contract, and I've just brought up a long-term chart here. This is in TradeStation at EC, which gives you the continuous contract for the euro versus the US dollar. And sometimes this is referred to as the 6E contract on Globex. In TradeStation they're identical. So the EC is the pit traded and the 6E is the Globex traded. Just the data that comes through TradeStation is all represented on the EC symbol. So you can see here that there's been actually some pretty rapid growth over the last 18 months or so. We had a lot of activity a couple of months ago in the euro when we kind of got up above 9 million contracts traded in a month here. But we're starting to average about 6 million contracts traded on the CME exchange, the Globex exchange, on this futures contract. So that's starting to get a decent size volumes that we can start to use for the better series of indicators. When I compare that with, I'm just going to kind of go down to, this is the E-mini euro contract. So this is the E7 contract, again a continuous contract at E7 on TradeStation. But you can see here the volumes that are going through is only about 100,000 contracts, so it's a lot smaller than the EC contract. And then the other contract that's available on the CME exchange is the M6E contract here. There's not a continuous version of this one, so I've just plotted this latest one, just showing the last kind of months of data here, and this is even smaller still. So this is known as the micro contract on the CME, and here we're only trading about 40,000 contracts in a month, so extremely small there. But if we go back to the EC contract, the Globex Euro contract, that's a pretty decent size at 6 million contracts traded. We know the euro is the largest kind of contract traded. What about the British pound? So similar chart here, just looking at the monthly volumes traded. We were trading about 6 million on the euro here. The equivalent number for the pound, so this again using TradeStation symbols at BP for the British pound here, this is only trading about 2.5 million contracts, so it's less than half the size of the euro here. So again, another reason to use the euro, lots of liquidity there, and that's fairly representative of what's going on in the cash market.